Hi everyone, this is Kevin Brinkman, and this is the Brinkman Report. I'm excited to have Chris Nebenzahl with John Burns Research and Consulting on with me today. Chris has 2 degrees from the University of Denver, was the Director of Institutional Research at Yardi Matrix, Director of Economic Research at Radix, and now the Vice President of Rental Research at John Burns Research and Consulting. He's an absolute expert on the multifamily rental market, and I'm excited to get his insights today. Thanks for joining me, Chris.
Kevin, it's great to be here.
Awesome. Well, I want to start with just the basics, and in multifamily, it's really supply and demand. So let's start on the supply side. I know that's had a big impact on the market over the last couple of years. Where do you think we are in this delivery wave? Um, if this was a baseball game, what inning do you think we'd be in?
I guess spring training is wrapping up and opening day's right around the corner, so we might as well use the baseball analogy.
Exactly, right?
I'd say we're probably in the sixth going into the seventh inning, approaching the seventh inning stretch. We're definitely past peak deliveries, but we still have a lot of supply coming online, and it's in a number of markets across the country. We saw this historic supply wave start really in the beginning of 2023 with deliveries accelerated last year. Peak deliveries was sometime in the third or fourth quarter of last year, depending on where you are. But we're starting to see that crest a little bit, certainly here in the mountain region, but also in the Sun Belt. The Sun Belt is where we saw the vast majority of supply come online in this current wave. Markets like Austin and Raleigh, across Dallas, into the Carolinas, Georgia, Florida. But we're starting to see that pull back a little bit, which is good because we've seen fundamentals soften, we've seen occupancy decline, rent growth decline, and now you're starting to see some of the impact of that slowing supply. Even though we had historic supply last year, demand was very, very strong. We absorbed something like 500,000 new apartment units on net last year. The only problem there is that we delivered about 600,000 units total. So the supply is still outweighing the demand ever so slightly. But like I said, sixth, seventh inning, we see the light at the end of the tunnel. By the end of this year, we should be past the supply wave. And then that supply is going to drop off very, very quickly. The deliveries will drop off quickly because we haven't seen many starts at all for the past year and a half.
I want to make sure I heard those numbers right. So did you say, was this 2024, there were 600,000 units delivered, 500,000 absorbed? What's a normal, like, historic average for both those numbers?
Yeah, so in terms of supply, I'd say a good healthy year, a good normal year is anywhere from about 300 to 400, maybe
Okay.
450,000 units. Um, Going back to the previous cycle, remember coming out of the financial crisis, we weren't building hardly at all. We were building 200, 250,000 units. It wasn't until kind of 2014, 2015, 2016 did we get back above that 300,000 unit level. And we built about 350 to 425,000 units
Hmm.
between about 2016 and 2021, call it. Certainly with the pandemic, we had that huge run up in demand. Rents went crazy, occupancies tightened everywhere. And money was also pretty cheap. So developers came in en masse, got those projects started in 22, started delivering 23. We saw the peak deliveries last year. So again, average year for supply, 350 to 450, 350 to 450,000 units. Demand right around there. We've seen
Hmm.
very strong renter demand really going back to the financial crisis, as we've had uh, affordability challenges on the for sale market, both with price increases as well as now you've got interest rate challenges
Hmm.
and headwinds there. But really demand has kind of stayed pretty in line with supply in that 400,000 unit absorption per year range.
And that's been the big surprise, right? I don't think many people predicted that. So what has that contributed to? Is it just how strong the labor market's been? Is it just how expensive, for sale housing's been? Or what do you contribute that huge absorption to?
I'd say yes, yes, and yes.
A little bit of everything. Yeah.
The labor market has certainly been strong. Now we're starting to see some potential cracks in the labor market. There's been concern over what's going on kind of behind the scenes. The job numbers are still positive, but the underemployment rate seems to be ticking up. Some of the other measures are showing signs of concern. But really, um, going back to the pandemic, we've had very, very strong job growth. The pace has slowed, but job growth is still there, and that's one of the main drivers, if not the main driver, of household creation and renter creation, renter household creation. So the strong economy has certainly been the backbone. I'd say we also got an uptick from immigration in 2023 and 2024.
Yeah.
Now, the current administration's policies are counter to a lot of the immigration trends, so that might be another headwind that we face towards demand in the future. But
Hmm.
immigration, both for high-paying jobs and low-paying jobs, was very strong over the past couple of years, and that contributed to renter household creation and apartment absorption as well. And also, I'd say domestic migration. Domestic migration has slowed down a little bit, but we're still seeing domestic migration, especially on the regional level. And I know we'll talk about a couple markets that you're focused on towards the end
Hmm.
of the podcast, but the domestic migration to the Sun Belt, to the mountain region, coming out of the Northeast, Midwest, and California is still pretty strong. And that's contributing to a lot of absorption of the new apartment units that are delivering, excuse me, in the Sun Belt, in Phoenix, in Denver, in the Mountain West as well.
Yeah. I read some of the material that you've put out, and it seems like the stat you use is, 4 to 6 quarters, after a start of a project is when you usually see kind of deliveries. And a lot of the markets that we're in, there really aren't like mid-rise projects. They're all kind of 3-story stick built. And they're probably closer to that, yeah, 12 months kind of delivery. And so I think a lot of the delivery stopped maybe the latter part of 2023 when interest rates really went up. So a lot of those we've seen already kind of even the last deliveries have delivered. And so we're thinking that, we'll be able to, concessions start burning off, start getting back to rent growth this year. What's your take? Is it that maybe the smaller markets where it's a smaller projects get delivered sooner, and that's like a 2025 event, and then the more urban, higher density, bigger projects that take longer, could that go to 26 and 27? Is that kind of how you look at it?
Yeah, absolutely. And again, a lot of this will be market specific and even sub-market specific.
Yeah.
You look at a market like Austin, they've been the poster child for oversupply. Even here in Denver, you look at a sub-market like Rhino.
Yeah.
Now the good news in Rhino is that the you're starting to see fewer and fewer cranes, which means there are fewer and fewer projects. But Denver as a whole, I'd say, is slightly oversupplied. Pockets like Rhino and the Golden Triangle are heavily oversupplied. So it may take into next year, perhaps into 2027, until those properties reach stabilization. But yeah, for most of the country and what you were saying for some of those smaller projects, I do see some positive momentum by the end of this year, perhaps even Q3, Q4 of this year. We're starting to see stabilization and occupancy in almost all markets. The
Mhm.
handful of markets are still struggling, still seeing the occupancy decline at the market level. But for the most part, occupancy is stabilized. And once you get occupancy to stabilize for 4 or 6 months, especially heading into leasing season, we're recording here on the 27th of March. The next 3 months will be very telling in
Yeah.
terms of what the year is going to be. But I am optimistic by the end of the year, flat or slightly positive rent growth. I don't think anyone's going to celebrate 50 basis points or 80 basis
Hmm.
points of rent growth, but hey, rents won't be declining. And I
Yeah.
think that's a material change from what we've seen in the last couple of years.
Yeah, and it seems like the consensus is that, with the housing starts that have just dropped off a cliff, like you mentioned, that once we get through this supply wave, that we'll have really healthy growth once again, 26, 27, 28. So if you were underwriting an acquisition, I mean, what would you think rent growth is going to be kind of moving forward? What kind of assumptions would you use?
Yeah, that's a great question. And the term you're hearing all over the industry right now is untrended. No one wants to trend
Yeah.
rents. No one wants to, expect rent growth, especially coming off 2 years of negative rent growth
Yeah.
in a number of markets. When I'm talking to developers on the multifamily side, the build to rent side as well, everyone's saying, oh, we're being conservative. We're going to underwrite maybe 2% rent growth, 2.5% rent growth, or they'll say we're going completely untrended. But the way that some of these deals are trading at cap rates really around
Mhm.
5%, maybe some even in the high fours, most in kind of the low fives, in order to make that deal pencil, I think there's got to be some, you know, either back of your mind assumption or hope that there's going to be decent rent growth. And personally, I'm with you. I think we'll see 3 to 4% rent growth, probably by 26, 27. With each passing month that we don't start new projects, 2028 is actually looking better and better. Um, but the way the way that people are talking and underwriting now, it's like the deal's got to work with very limited rent growth. I just don't see that happening if deals are still trading in the fives and we've got,
Mhm.
a 10-year treasury at 4.3 or wherever it was this morning.
Yeah, I totally agree. I think you're talking to some of the same people I am because I think and I think those folks are mainly on the sidelines. If you underwrite a deal with untrended rents and then like 50, 75 bip cap rate expansion, you know, no deal is and want high teens IR, no deal is going to work. And I think that's the majority of people that are saying that are on the sidelines right now. We just we're in a process competing for an acquisition, and we were at a almost a five cap, and we were probably fourth or fifth on the bidder list. So I think those folks who are winning those, have to put that rent growth in there, and if not cap rate compression, it's maybe going out at the same cap rate they're going into it right now. Um, so what are you seeing for exit caps? Because everything is so sensitive to that. How are people looking at that and underwriting that in your mind?
Yeah, and I think it varies depending on the group and depending on the acquisition folks that are underwriting. I think it's really tough to underwrite any cap rate compression in this environment. Um, Will the 10-year go down? Could the 10-year go down? Yes, I believe it could. Could SOFR go down? I believe that could go down as well. Hopefully, it's for the right reasons. Hopefully, it's not because we're in an economic recession or an economic contraction. Hopefully, it's because inflation's under control and so forth. But the spread between cap rates and treasuries is so narrow right now.
Hmm.
I could see that spread widening to a more normal level and cap rates holding where they are, low
Yeah.
fives, mid fives. To underwrite a ton of cap rate compression, I think is pretty tricky. And you look back 2 or 3 years ago, and obviously it was a different market because we saw the massive run up in interest rates. But I think a lot of people were underwriting cap rate compression from 4.75 to 4.25 on some kind of middle of the road
Totally. Yeah.
assets. And to underwrite that kind of compression, I think is a little tricky, especially in this environment. So you asked about exit caps. One thing, and I hope we don't go too far off on a tangent here, but I think the hold period of this next cycle is going to have to increase. So, the traditional 3 to 5 year hold or a quicker value add than that, I think in order to get real good value out of a lot of the deals that are coming to market today, you're going to have to
Hmm.
look at 5 to 7, maybe even 10-year holds on certain areas. So with that said, what does the cap rate environment look 5 years from now, 7 years from now, or 10
Hmm.
years from now? It's tough to forecast that far out, but I would say keeping cap rates steady or maybe, a slight expansion, 25, 50 basis point expansion is probably where I would see things going. Again, mostly driven on that normalization of the spread between cap rates and treasuries. I don't see treasuries going back down to zero, or the overnight rate going back down
Yep.
to zero. I don't see treasuries going back to 1 or 2% on the 10-year. So there's not a ton of wiggle room, maybe 150 bips, but I, on the cap rate side, I think kind of keeping things flat is probably
Yeah.
the way I see things shaking out.
Yeah. I totally agree on the hold period. I think the same groups I kind of mentioned that are on the sidelines right now. A lot of them are real estate funds that are IRR driven for the promote. So it's the shorter the period, the easier it is to get a higher IRR. So a lot of them are kind of can they get a high teens if they and get in and out in 3 to 5 years? And there's just really no way you can do that if you want to be conservative and have untrended rents. So I think those that are active, and these are a lot of our investors on our current deals, are more family office patient money that is really looking at, wow, this is a great basis, well below replacement costs, and I can wait 7, 10, 12 years and wait to time it until it's a strong market again. And then when I think these exit caps, will be there, and that anything going to be built between now and then is going to be more expensive. But I've heard people talk about, and I'd be interested if you have any guesses on this, just in a cap rate, like what percent of that is driven by interest rates, and what percent of a cap rate is driven just by capital markets, and how much capital is chasing deals? Because I think we always talk about interest rates and how that drives everything in cap rates, but there's PhD economists that believe like the amount of capital chasing deals is even more impactful. And I'd say right now there's a real shortage of capital. So if you look at now as a shortage capital, I think in the future at some point there'll be more chasing these deals and cap rates could be lower. Have you ever seen any data on like what percent is driven by interest rates compared to capital availability?
Yeah, I haven't seen the specific breakdown of, X percent of the cap rate goes to this, Y percent goes to that. But I do agree with your point about, more and more groups and more types of capital providers coming into multifamily. Family office for sure. Sovereign wealth funds are getting a lot more active in the housing space. You go back 5, 10, 15 years ago, and the sovereign wealth funds were big into, downtown Class A office buildings in New York, San Francisco, and Boston, right? Well,
Mhm.
times have changed and there's no longer, the safe trade or the liquid trade in those assets. And so I think you're seeing a lot of that capital come to multifamily. Um, when you get some of the folks that are on the sidelines, the PE firms, the hedge funds, when they start to come off the sidelines, um, and potentially even the syndicate groups, I think the syndicators were the ones that were most burned in kind
Mhm.
of the 21, 22, 23 run up. Um, with each additional investor class or investor group coming back to the market, there's more capital chasing after this, limited pool of deals. And again, as we mentioned, the development deals that are going to deliver in 2026, 2027, 2028 will be far fewer than what delivered in the past couple of years. So there's going to be even more capital chasing even fewer new deals.
Yeah.
You could see some aggressive behavior on the cap rate. That wouldn't surprise me at all. Um, and I don't underwrite deals myself, but if I were looking at kind of the whole spectrum of the multifamily market, I would probably keep cap rates flat, but there will be aggressive capital come in and say, hey, I really want this deal. I'm gonna sharpen my pencil and I'm gonna, expect or hope for cap rate compression, or I'm gonna underwrite at a high four, low five, or I should say sub five cap rate.
And when do you think that transaction volume turns on again? The the litmus test I always look at is maybe when it's a positive financial leverage environment. So I mean, interest rates would have to come down, cap rates have to go up, but I mean, there's a chance that might not happen. So I mean, what are the indicators you're looking at? Like, okay, this is when it gets back to normal.
Yeah, I think the first thing I'm going to look at is stability in the treasury market.
Yeah.
Stability in the 10 years, stability in SOFR, depending on how you're underwriting and what your loan is tied to.
Hmm.
Um, but there's been so much instability, um, certainly going back to 22 and 23 when rates were just kind of flying off the charts. But even recently, we saw the Fed start to ease, cut rates last year. I think there was a lot of expectation of, okay, this is kind of our slow glide path. Um, the change in administration, and this is not political, but the policies and the rhetoric that have taken place have sent the treasury markets into a bit of turmoil. And so I think with the volatility in the treasury markets, you see more and more people on the sidelines. Can deals get done with the 10-year at 4.3? Yeah, they can get done. Can they get done with SOFR at 3.75 or 4, wherever it is? They can. What I think is keeping people on the sidelines is they don't know if the Fed's going to cut rates next
Hmm.
month, and are they going to cut rates because inflation's down, or are they going to cut rates because we're heading for a recession?
Yeah,
Is
yeah,
the 10-year going to go from 4.3 to 5, or is it going to go from 4.3 to 3? Um, and I think that volatility and that risk is keeping people on the sideline. But once you get kind of a stable treasury market and you combine that with even more clarity, and we're getting more and more clarity with each passing week
hmm,
and month on what the supply situation will look like at the end of this year into next year, what the demand situation will look like as well. I think you'll see those players come back to the market, and it could be as soon as kind of mid this year, maybe Q3 of this year, excuse me.
yeah.
If we get a strong rental season, if we get a strong leasing season, and we get some stability in the treasuries, it wouldn't shock me if there's more activity towards the latter half of this year.
Yep, yep. Yeah, hoping there's more stability as we go through. I think the administration's focusing on tariffs right now because they could do that at executive level. And I know going through Congress on the tax side and regulations that I think the sooner there's clarity in all those things, I think the better for sure. Um, well, I appreciate that on kind of the multifamily basics. I'd like to jump into specific markets if you're good with that. Would you mind
Absolutely.
just kind of sharing the state of the multifamily? Let's start in Denver, if you don't mind.
Yeah, absolutely. And I know we touched on some submarkets in Denver already. But Denver, again, I see Denver similar to a lot of the country and many of the Sun Belt markets where there's a light at the end of the tunnel. We went through our peak supply last year. We've been ramping up pretty quickly. Um, we will absolutely deliver fewer units this year than we did last year. But it might be in line with 2022 and 2023 numbers, which is elevated on a historical basis. So we're not completely out of the woods yet here in Denver, but there is some light at the end of the tunnel. Again, there are pockets that will likely struggle. I mentioned Rhino, I mentioned the Golden Triangle, the 225 and the E470 corridors. There's still a lot of development going on out in Aurora, up towards Green Valley Ranch. But thinking of Denver kind of in the broader sense, or really the Front Range, we've seen a lot of growth continue in Longmont, in Loveland, in Berthoud, in Greeley, in Fort
Hmm.
Collins. So that stretching of the Front Range, that stretching of the I-25 corridor is going to continue, and I see some pretty strong growth prospects north of the Denver metro. Um, we talked a little bit about domestic migration. Denver, as a metropolitan statistical area, has actually been losing migration on a net basis, but it's not like we're losing them necessarily to Texas or Florida the way states like California and New England and the Midwest are. People are moving out of Denver for Fort Collins, for
Yeah,
Greeley, for Longmont, for Colorado Springs. So the Front Range en masse is still growing from a population perspective, but the density of the Denver metro is softening a little bit. Same with Boulder. There's out migration from Boulder,
yeah.
but mostly they're going into Broomfield or Superior or Louisville. So the overall region is still growing.
Gotcha.
Occupancy in Denver is still trending down a little bit. I'm looking for stability in occupancy in the Denver market, especially in those submarkets that have seen just so much supply added. But again, I see some long-term strength for Denver. Denver has become, I would say, a Class A institutional market for a lot of buyers. Going back 10 years, it was just the gateway markets. Then it was Dallas and Houston.
Hmm.
Denver is certainly one of those markets with Dallas and Houston and Phoenix and Atlanta. If it's not the top tier like a gateway market is, it's just under there. And so there's a lot of capital interested in the Denver market, looking at coming into the Denver market. And I think our economy is still in good shape. We've had some softness in job growth, but you look at kind of the overall diversity of the Denver job market, I
Hmm.
think we'll recover from that. And so I'm looking at kind of rent and occupancy recovery late in 2025 into 2026 for the Denver market.
Yeah.
Some submarkets will take longer. Some submarkets are already showing signs of growth.
I'd be interested in hearing on maybe Salt Lake, and then we'll go to Boise after that. But I kind of look at Salt Lake as maybe what Denver was 15 years ago, and Boise, I think, is maybe what Salt Lake was 10, 15 years ago. So you can kind of see what the evolution of these kind of cities could be. But we have experience in our portfolio a lot of supply in the Wasatch Front, and it's probably, we think maybe another 6 to 12 months, kind of longer. We're going to be competing with new supply than we have maybe in the Front Range. What's your take on Salt Lake?
Yeah, you make a really good point about, Salt Lake lagging Denver, Boise lagging Salt Lake. I think that's spot on. And a couple of areas of comparison that I'd see. One is in kind of the economy, and Denver certainly went through kind of this tech boom probably 10 to 15 years ago, has established a really strong tech presence. Salt Lake City, the Silicon Slopes, and a lot of the
Hmm.
tech employment that has moved in there, again, lagging Denver, but showing a similar trend. The other thing I'd say is just geographically. You look at Denver, you look at the I-25 corridor, kind of bordered on one side by the Rockies.
Yeah.
Salt Lake and the I-15 corridor is very similar. You can't really build out too far east or west in Salt Lake. Denver, we can certainly build east, but Salt Lake, you're kind of stuck in the valley. And so the
Yeah.
growth has really been vertical.
Yeah.
Provo, Orem, Ogden, Logan, and you're seeing a lot of that growth, both in supply and in kind of population growth, demand, job growth take place there. When I'm looking at the supply side in Salt Lake right now, there's still a heavy, heavy concentration just west of downtown, just east of
Hmm.
downtown in that urban core. So I think Denver's development is spread out a little bit more. Um, to the east of the city, to the north and south of the city. You are still seeing development in Provo. You are still seeing a good pocket of multifamily supply come on in Lehigh. And so I think that's going to take a little bit longer to absorb. Again, especially in those pockets. The Salt Lake market, I think, is well positioned. And overall, if we see the demand drivers continue, the in-migration from California, the in-migration from other states, that strong job growth, then I think you'll see the Salt Lake market bounce back quickly. But I
Okay.
do agree it's probably going to be a little bit later than the Denver recovery.
Yeah. Gotcha. Well, let's go to Boise, and we bought in Nampa last year, and in our underwriting, we're really conservative on. We had negative rent growth, we had high vacancy in our pro forma, just really nervous about the amount of supply. And we've been pleasantly surprised just how strong the demand side has been there, where we're, 95% occupied, and we'll probably have, solid rent growth this year. So I'd be interested in hearing if that's just a little microcosm that where we're at, or are you seeing that more in general in that market?
No, I think that's pretty accurate. And again, geographically speaking, Boise's more spread east to west, and we've seen development right along kind of 84 and in the urban core. There is a lot of development, getting back to this idea of pockets of development, like we talked about
Yeah.
in Denver and Salt Lake. Midway has got a lot of development in the Boise area, and then downtown Boise still has a lot of development. The kicker with Boise and with any of the smaller markets, you could, make the same comp to some of the Montana markets. You could make the same comp to Salt Lake, 10 years ago. But when you have a market this small and it's flooded with supply on a percentage basis, not even
Yeah.
on an absolute unit basis, because Denver and Salt Lake will still deliver more units, but on a percentage basis, then you get kind of that wild volatility in the rent growth and the occupancy, and you're kind of banking on continued demand and continued inflow. Boise was one of the most popular markets we saw in the immediate wake of the pandemic, where people were leaving San Francisco, people were leaving LA, saying, "I don't want to be in this high density area. Boise looks beautiful. Let's give
Yeah.
that a whirl." I've been quite impressed with the number of people who've stayed. And I think that's
Yeah.
testament to the city, to the region, to the culture, to everything that's going on. And it's not purely work from home employees. I think there's a burgeoning in Boise economy, but that presence of work from home employees, I think, is here to stay. Amazon makes the headlines, Salesforce makes the headlines, bringing everybody back to the office. But when you look at the data en masse, more and
Hmm.
more companies are allowing people to work fully remote. I think it's something up to about 40% compared to pre-pandemic when it was 12%. But even 2 or 3 years ago, that number had fallen back to 35% or whatever of all office working employees were able to work remote. So I think the work from home, work remote trend is here to stay. And
Yeah.
so then you look at markets like Boise, where there's clearly a demand, there's clearly an appeal, and I think that's going to continue to see sustained demand.
Hmm.
And I don't see a ton of supply moving in immediately after this supply boom.
Yeah.
Just going back to the supply story a little bit, um, not only is it, where the demand is, that's kind of the easy supply and demand balance, but it's hard to get any development projects penciled with these type of interest rates. Then
Totally.
you tack on potential tariffs, construction labor challenges, and I'm getting more and more pessimistic on the starts, whether it's in a high demand market like Boise or an oversupplied market like Austin. I don't think the starts will take place anywhere.
Yeah. The last question I had for you, and we talked about this historic supply that's gone through, and I'm just shocked to look that after all of this, we're still undersupplied for housing in the US, right? Could you talk a little bit on that? If you can differentiate the difference between for rent and for sale on that?
Yeah, absolutely. So, based on our last estimates, we're about 1.2 million housing units undersupplied, and that's a split of multifamily and single family. The multifamily development cycles are much more volatile. I'd say the single family builders, they can build one house, they can choose not to build the next house or build the next house and the next house and the
Yeah.
next house. Multifamily, as you know, we're bringing on 100-unit properties at a time, 300-unit properties at a time. In Salt Lake, when I was looking, excuse me, there are a ton of big projects, 550-unit deals, 600-unit deals, kind of across the valley. And so those developments are much more volatile. But getting to kind of the long-term undersupply, we do estimate that we're more than 1 million units undersupplied. And that's just based on kind of continued demand, continued rent growth in renter households, and continued immigration, continued growth in the renter base. Specifically with multifamily and specifically with rental households, we see the cost of homeownership as a huge challenge. And that's why there's been elevated demand on the renter side. And that's for single family rentals as well, not just multifamily. But the cost of owning a home, and that's, your principal, your interest, your taxes, your insurance, it just hit 2x or 101% higher than the average cost of an apartment. So
Wow.
for me, that was kind of an eye-opening moment. Maybe it wasn't as numerically significant because that number's been growing, but it's psychologically significant that, hey, it's now half as expensive to lease an apartment as to buy a house.
Mhm.
Vice
Yeah.
versa, it's twice as expensive to buy a home on a monthly basis as it is to rent an apartment. So I think that's continuing to drive renter demand, renter household formation. But we are still undersupplied again by that million units. And so we need to continue to develop, we need to continue to build. Although I would also say, and this is more of a longer term issue, um, we likely will be facing kind of declining demographic tailwinds. So for a
Yeah.
while, we've had the millennials, the Gen Zs, large populations increasing and driving that homeownership and rentership, and the growth in household formation. We also had a strong tailwind from immigration. 2026 is 18 years after 2008. We know there was a big
Hmm.
baby bust in 2008. So that high school class will be going to college pretty soon. 4 years after that, they'll be, entering the workforce looking for housing. And not to say that household formation is going to fall off a cliff, but that's when we see kind of the
Yeah.
natural population growth really started to fall back in 2008. And so long term, there might be some demographic challenges, but right now we're still, as you mentioned, in a housing shortage. And so once we get through this kind of immediate glut of supply, I think demand will be there. You'll see rent growth come back, and in fact, we're going to need to start another supply cycle fairly soon.
Yep. 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 Well, perfect. Thank you, Chris, for joining me today. I appreciate all your insights. We'll leave your contact information in the show notes for any of the listeners that want to reach out to you direct. And thanks for listening, everyone, and we'll see you next month. Bye.
Thanks, Kevin.
See ya.